Foundation models are the fastest appreciating asset in history. Why invest in a business where the assets walk out at night? If I'm in Europe and I'm starting a company, I would get out. Lena Connolly said openly is, I think, a threat to American capitalism. Whether Biden or Trump gets elected, she needs to go. I don't buy that the IPO window is closed. The IPO window is wide open. The question is, what's the price you're willing to take?
Ready to go? Michael, I'm so excited. Dude, we've been friends for years, and this is the first time that we get to do this in person. So thank you for joining me.
Thank you for having me. The first time we get to do the podcast in person, but not the first time we meet in person.
No. First time podcast in person. But you know, it's so funny. I'm sure you find this actually, but I was saying the other day on Twitter that actually it makes such a difference doing in-person shows.
I totally agree with
Really,
you.
for me, it's game changer.
Thank you for having me.
Not at all, but I want to dive straight in because it seems like we're in this kind of bizarre AI bubble now. And we have one side of the table that says, no, this is the most transformational technology that we've seen in 20 years. And we have another side of the table that says this is completely nuts. The valuations are crazy. The amount of cash that's being burnt is crazy. This is peak. How do you just think about that from a starting point before we do a comparison?
One of the hardest things to do in the venture business is hold, and in life, by the way, is to hold two truths in your head at the same time. I think both of those things are true. This is the most transformational technology I think I will ever see in my lifetime. And at the same time, there is, like happens with many transformational technologies, just an incredible gold rush that brings in a lot of people. Both these things are true. You know, when the internet came on and I was starting my venture career, this is in 1995, it was incredible. I mentioned to you before we came on air, the first deal I did was called Picture Vision, and it was an online photo sharing when there were still cameras with film and negatives. You had to actually scan the negatives in order to send the pictures. You upload them, it looked like paint drying. To upload the pictures. And then there was pets.com and pets.com.com and pets.com.com.com because there's an incredible gold rush. But the internet, eBay, Amazon, et cetera, turned out to be incredible companies. And I think the same will be true about AI, which is, by the way, a giant bucket that we need to kind of break apart. And then, you know, right after the .com thing, people have forgotten, but there was like a fiber optic craze. Everyone's forgotten it because it's called the .com crash. But there was a fiber optic equipment and infrastructure craze. And we laid a ton of fiber optic cables and it was a bubble and the stocks went crazy. But we live off that infrastructure today. And that's what's made the current moment possible. Same thing happened, Cisco bought, blank on the name of the company, for $6 billion in the fiber optic routing space in, I think, 2001. Then that bubble burst. And, it took a bunch of years to kind of find our footing again. So yes, AI is the most transformational technology I think I'll ever see in my lifetime. True. It's also true that there's a massive financial gold rush going on in what turns into a bubble. True. What's also true is those bubbles create the infrastructure that we need going forward, and that's also true. So a lot of people are going to lose a lot of money during this, like a lot of money. And some foundational companies and technologies will be built.
Who are those people who lose a lot of money? I'm not asking for the names of those people, but what sort of styles, what behaviors, what categories is the ones that will lead to that loss versus the value creation?
Let's start with a non-obvious point, which is that there's a lot of LPs with a lot of exposure to a lot of the same kind of companies through multiple different funds. And they think they have portfolio diversification across a significant number of venture capital funds, but everybody's piled into the same trend, and in many cases piled into the same company.
Do you think LPs are aware of that?
I don't know. I think the best ones probably are, and others probably aren't. There's a second kind of category, which I call logo chasing. This happens in every one of these cycles where I got to be in the hot one. And there could be 5 or 6 or 7 hot ones, and I need to have that logo. Why? Because I want to tell people I'm in OpenAI, I'm in Character AI, I'm in Diffuse, and I'm in all these things. So I need to be in them. Then I think there's a third category of people who think you can replicate a model that exists in one geography and make it in another geography, and it's going to work to the same scale. And they pay up a high price, but it doesn't work in those geographies to the same scale. I think that's kind of a third category of people. And then I think it's important to say, our mutual friend Gavin Baker of Atreides has this line, which I completely agree with, that foundation models are the fastest appreciating asset in history. And I think that is absolutely true. I was talking to our founder of Seeking Alpha, which is a company, by the way, I did 19 years ago in Benchmark, and I'm still on the board of. And he made a super interesting observation, which is that financials or stock markets, which is a minute-to-minute update business or set of data, doesn't do well with a lot of these training models. So you can predict like a lot of things and even write an analyst report, but it doesn't matter because the numbers are off because they changed 2 minutes ago. And I think how we deal with also the refreshing of information, which is getting to a higher velocity, specifically in areas like financial and stocks, but that's going to be another area.
So we actually just released a show today with Aravind, the founder of Perplexity.
Yeah.
And I said to him, about the depreciating asset that is these models and what that means for their aligned price. And he said, you don't get it. The price is actually aligned to the teams that are able to bring these models together. That is where the value in these companies are. That is why OpenAI is worth $90 billion. It's not the model itself. It's the collection of specific people with specific skills that are able to bring them together that is worth the value.
Perplexity is my favorite app. It's on the home screen of my phone. And still, last I checked, indentured servitude was outlawed in the United States. And a little bit, it's like what Bill Gates' father said to him that everyone's forgotten. Why invest in a business where the assets walk out at night? So it's true that this is a unique talent business. But if you don't have a lasting kind of asset, and I do believe that software in that case of Microsoft was a lasting asset, the data is not. And the models, as we're starting to see in various ways, people are walking out the door, and some of them didn't work, right? There was Mustafa's company that was picked apart for its bones and flesh by Microsoft, and a very, very elegant exit, super elegant. And I think we'll see more of those. But I don't buy that 5, 6, 7, 8, 9, 10 of these are going to work. It's just not true. Financially, it's not true.
I think that you're going to see all the large cloud providers, Google, Amazon, you name it, essentially say, hey, we need to acquire the foundation models, your coheres, your smaller ones who can be acquired. And then you're going to see a battle for the crown between Anthropic and OpenAI. And so large cloud providers acquire kind of smaller providers, and then you have a battle there because they're too big to be acquired. Do you agree with that summary?
Could be. I think about it a little differently, which is where do people who use AI start their day? It's a little bit like the Google question, because I think as you kind of play this forward, you're going to see a whole series of agents. Like I'm not going to go to the NewYorkTimes.com to read it. I'm going to go to my AI screen and say, fetch me the articles that interest me from the New York Times today and something that, entertains me or is different or something I got to know. I think where people start their day is what's important. And then there'll be kind of an underlying layer that gets accessed via APIs, which feels like Anthropic is ahead on right now, which will service a lot of these companies. And a lot of this will be built into what you talked about, the hyperscaler stacks.
Do you think these are even businesses though for venture? They are so cash consumptive. We also have irrational financial buyers and investors who are obviously large corporates who have different motives to venture investors. Do you think foundation models are even an asset class that venture investors can make money in?
Yes. I don't think we should think about anything in the venture or startup business as an asset class. There are asset classes out there like commercial real estate. You can make money in a class. The venture business is completely sui generis. It's not a class. There is a small number of people in this craft who make money, and there's a small number of startups. The S&P 500 has kind of kept going up on the back of 4 companies who are venture backed, and these are incredible generational companies that have pushed forward. The rest of them are kind of, trailing behind, and we just need to focus on the question of, are all of these just incredible companies that will land themselves into some index and some some S&P 500 that works? I think the answer is no. And so this is not a class of companies, foundation models. There are 1 or 2 companies in there that will make their venture investors a lot of money, and the rest of them will cost their LPs and GPs a lot of money. It's just life. It's what it is in this business.
No, I love having you on the show. It's always my favorite chat. So I get you, and I agree in many respects. I do just want to break down then, when you look at AI, you said like we put it in a bucket. And like, what does that actually even mean? How should we break down that bucket? And how do you break down that bucket when you think about investing in it today?
So look, we invest only in Israel, and we've had a theory, we should back up one step, which is AI. The real moment is the LLM moment, which is AI has been around for a while. Like in 2013, we invested in a company called Windward, which is now traded in London, which does maritime AI. That's true since 2013. In 2015, I invested in Lemonade, which was AI for insurance. We said bots, not brokers, before bots were fancy. Okay, what's happened in the last 2 years or so is the emergence of the LLM, which is yet another leg up, or a different way to kind of prosecute AI. AI itself is not new. When you think about that for a second, the bucket we look at, we invest only in Israel. We asked, can Israel do foundation models? We said no, and we've said that for a very long time. Why? Because a lot of this comes out of academia, it comes out of a lot of these very large companies. We didn't think there was the talent density in Israel specifically for foundation models, because a lot of the Israeli technology comes out of the military and not academia. Why is France so good all of a sudden at AI? Because of academia. And what we said was, what we want to do is applied AI. And what we want to do is kind of full stack stringing through the system of AI.
How do you think about industries which are right before AI to be fully efficient in terms of every process from start to finish, or as much as possible, versus those that are not actually and cannot be verticalized in that way?
I don't know the answer to the question.
That's the first time anyone said that on 20VC. Well, let me tell you, Harry.
What's an area that I think there can be efficiencies in? Places where there's a huge amount of paper processes, where people are overburdened, but it's kind of compressible into a bunch of short workflows that you can kind of use AI to do right now. But I think kind of more broadly, there used to be nuclear countries and non-nuclear countries. Now they're going to be AI countries and non-AI countries. And in the same way, there's going to be AI companies and non-AI companies. And I think what's going to be shocking about this, that's not like the internet, is it's going to be harder for legacy companies to catch up to AI companies, which is different from the internet. You could kind of keep your retail business and still do e-commerce. You could kind of, in the early days in the 90s, we had this thing called the intranet, which is how Fortune 500 or Fortune 5000 companies embrace the internet into their companies. And they used the internet and they got better at customer service and they digitized. AI is different. If your data is not set up right, you're just not going to get there. And I listened to Warren Buffett say about his insurance businesses that they thought they had 60 different databases. They found out, I can't remember if the number was, they had 600 or 6,000 different databases. They didn't talk to each other. It's like, good luck. And when I heard that, I said, we should hold our lemonade for a long time.
Can I ask you, when you think about like value accruing in the stack, I think what I worry about with a lot of them is customer service AI, SDR for sales teams AI. There is so many competitors in very specific niches, whatever.
That's not a specific niche, by the way. Those are classic areas where software has done work. There was Siebel, there was Salesforce.com, there was Zendesk, those are classic areas where people run to first. And I think the more interesting places to invest, not to overuse Howard Marks's 4 quadrants of non-consensus right, but is to look for kind of out there things that it's hard for people to compete in because you have specific domain knowledge that other people don't have.
So I really don't like competitive markets when I invest. I find that you have really challenging times in terms of product marketing. You have higher CACs, you have lower retention rates, higher churns, you're all competing on the same channels. Do you agree with me, or do you take the view that no, competitive markets are competitive because they are where big markets are?
I'm in the Harry Stebbings camp.
Thank God. We would edit it out if you weren't.
I on one hand, I never think about competition because I don't think that's what undoes companies. Competition, I think bad execution undoes companies. And at the same token, I prefer actually market education. I prefer these completely kind of uncharted spaces. I'll give you, a few examples, but like we just backed a AI to synthetic biology and chemistry rocket fuel company. And you go, rocket fuel? So on one hand, it's very competitive. A lot of people provide rocket fuel, but there's nobody who provides synthetically engineered rocket fuel from the bottom up. That's at 1/12 of the cost. And I just, we may succeed, we may fail. I don't know. There's a lot of market education that will come to saying, hey, we're not going to take oil and refine it. Instead, we're going to build it from the bottom up. It's going to take a lot of market education to do that, but I think that's okay. I much prefer that.
How do you size that in portfolio? So it's like that is a inherently more risky play than a SaaS business or a fintech business, I would argue. How do you size that in a portfolio?
Oh, so I don't think it's a more risky play than a SaaS thing. I'll argue that SaaS is way more risky. One, because of the competition and price erosion. It's just, we get a false sense of security from models. Like I can pull the model forward. I gave this presentation at our annual meeting a few years ago, which I said, we've hit peak SaaS. Anytime you can kind of stamp out MBAs from universities, you can pull the model forward, that's not going to be a venture business. When I hear people talking about some of the growth funds, software is like a bond, with a higher yield. I go, just no. That's not the venture business. I gave you cringe from that.
Yeah, goosebumps and like
So,
software's like a bond.
You know,
like,
that you have tons of growth funds and even PE funds thinking that they can predict the future revenue software. In some cases, you can. It's not that you can't, but doing that as a strategy, I think it's both inherently risky and non-remunerative because it's really, really, really tough to be unique. You know, when I first joined Benchmark in 2005, I had some time on my hands and have a portfolio. So I did this little piece of research to try to figure out why do companies get premium multiples. So the obvious answer is high growth, right? But it wasn't always the case. And the thing I discovered, I kind of called and interviewed at the time sell-side analysts on Wall Street who had a more prominent place in the world in those days. And in all my research, I came away with the following insight, which is companies get premium multiples when it's the only way to play a future trend in the public markets. And so if I think the world is going towards X, AI, whatever it is, and I'm the first AI company, the only AI in a given market, I'm going to get a premium multiple because it's the only way public investors can play that trend that they want to play.
This is NVIDIA, no?
I think this is big time NVIDIA. And so being unique actually has real value. Again, provided that you have the growth and the gross profits, et cetera. You can't ignore that stuff. But all things being equal, if I have multiple ways to play a market, you'll get a lower multiple. If I have a single way to play a market evolution, I'll get a premium multiple.
I actually think about this a lot too, and I'm just like looking at, I've got the founder of Klaviyo on the show tonight, which is a $7 billion company, doing $750 million a year in revenue, growing 60% year on year.
It's quite remarkable because most public companies today in the software space are going 10 to 20%, which is part of my peak SaaS theory.
It's absolutely remarkable, but the multiple on it is not great. I think the multiple is like a 6x or a 7x. And then I look at an Atlassian, which is trading at a 12x. And it's not an inherently better business. And I'm just trying to figure out the difference between the two. And to your point there, like why one is premium and one is not.
I don't know enough about either business to have a view as to why Atlassian's trading at 12x, but I would assume that if you want to play kind of developer growth, which I think is a real trend, that's why you want to own Atlassian. There are more developers in the world today. It'll be interesting to see what happens with AI, but I think in general, horizontal SaaS processes are going to be disrupted by AI. We just actually did a portfolio review where we looked at we categorized our investments. Of the last 17 investments we made at Aleph, one was a SaaS company.
Sorry, last 17 investments, all but one was a SaaS company.
No, only one was a SaaS company.
Vertical or horizontal?
Horizontal. Only one was a horizontal SaaS company.
When we look at a lot of the big companies that we see today, and I'm not naming any or denigrating quality or anything like that, but like your Airtables, your Notions of the world, these are all horizontal SaaS companies. Yeah. Bluntly, a lot of people say, well, AI actually kills vertical SaaS because it means that the cost of creating that same vertical SaaS but customizing it for your organization is way easier. So vertical SaaS is the one that dies.
I heard a rumor, I don't know if it's true, but I've heard it from 3 people now, which either means I'm in an echo chamber or it might be true, is that Amazon has said, don't buy any more software. AI can take care of all the kind of business process needs we need in software. I think that's going to be a trend. And so I think you'll see...
What does that mean?
I think you'll see a lot of companies build their own software. Or you have tools that create kind of unique business process software for a lot of these companies. I don't know if it's tomorrow or in 5 years, but I think there'll be more of that. You're skeptical.
Well, no, I'm just like, I think we drastically overestimate the internal education or knowledge of company employees. And I don't mean that disparagingly, but, when we look at Accenture, they just posted $2.4 billion in generative AI revenues.
Why is that?
Because companies have no freaking idea how to integrate AI into their business units.
Well, what kind of business is Accenture?
It's a consulting business.
Right. It's not a software business, consulting business. So you have unique knowledge. By the way, McKinsey is also doing extremely well today in these at-risk fee businesses, right? They're not taking a lot of their fees today in kind of consulting fees, but they're saying, we can improve your bottom line. We can improve your top line. And they go in there and they use a ton of software and a ton of data that they've bought and created themselves, right? The fastest growing business inside of McKinsey is software. And they go in and say, I can bring like a lot of really, really smart people and a lot of technological capabilities and upgrade your business into the next era. That either does or doesn't include off-the-shelf software. I don't know, but I think there's a lot less of it going forward. again, you have to ask yourself a very simple question. I'm more of a big picture guy than a micro guy, but why are so few of these companies growing better than 15, 20% in the public markets? You can barely find any. I think the market for purchasing software is slowing down.
100%. Well, so I mean, there's a couple of different options. There's one, you could have like a box, which is just like the saturation rate of the market is so high already. I mean, they already have pretty much everyone as their customer base. They need to upsell a new product, which they've been, Aaron will admit this, so I'm not shitting on him, but too slow to do. Same with the Dropbox as well, which Drew would admit too. Or to your point, they're slowing down or not buying as much.
Whatever it is, I think it's slowing down.
Yeah.
So, is that a trend? I don't know. I think we've squeezed a lot of efficiency out of businesses using kind of basic software already. And so to get to another level of efficiency or revenue generation is a big deal. I think also corporate buyers in whatever business they're in, what they're interested in is not the software to squeeze the incremental dollar of efficiency out of my business. Is where's my new revenue opportunity from this? And that's going to require kind of a big leap. And you don't get that in traditional SaaS software.
I guess the question that's interesting there is like, are you able to actually extract value efficiently? Because if you are making millions and millions for your customers in that way, how do you actually extract the value that you are providing in an efficient way that's not like a SaaS model where you only get 50K and you're actually saving them 10 million?
I think buyers today are willing to pay for value. I think there's a bunch of reasons for this. It's harder for companies who are used to price per seat models or used to large enterprise to kind of adapt to this. There's been a bunch of pieces written. I think Sarah Table wrote one that people pay for work. Yeah. I think that's a real thing. I think people will pay for improvements to their business, and I think the consultants like Accenture and McKinsey are the leading edge of this. But I think it's going to come into software very, very quickly.
Yeah, no, I totally get it. Can I ask you, I remember speaking to our mutual friend Mark Evans before, and he said, hey, the thing you just always have to remember with adoption cycles is we always overestimate in a year and underestimate in 10. So just breathe. And I just always remember that. And it really actually affects how I think about investing and adoption cycles. Do you think that's the case here? Or do you actually think, no, we are seeing the fastest technological breakthroughs in development within LLMs every single week? It is a velocity that we haven't seen before.
I think both of those things are true again.
Well, wise man once told me that it's about holding two opposing opinions.
Exactly. I think the adoption is incredible. I think the pace that these things are learning at and adapting at is incredible. I mean, by the way, you see the efficiency in customer service at a lot of these fintech companies, was Lemonade or Adyen or Klarna or any of these people. It's stunning. And at the same time, when you kind of look across a broad economy, it's going to take a lot longer than people think, and there'll be some disruptors and some people who get this and regulation will have something to say about it. Not in the way everyone's talking about, is Sam Altman trying to do regulatory lock-in, but there's just a lot of businesses that are regulated, like pharma is regulated and financial services are regulated. And, it's hard for regulators to keep up with AI, and that's going to be a big deal for how much it can be deployed.
So my biggest concern actually is that you have regulators who fear that it's getting away from them, place these very punitive policies or regulations on data access, and actually we have a real plateauing in the development of AI systems because of regulatory challenges.
Super high level. I think that's more likely to happen in Europe than in the US.
Agree.
I think that is going to set Europe back in competitiveness more than it's already been set back in competitiveness over the last 20 years. If I'm in Europe and I'm starting a company, I would get out. Sorry.
Oh, thanks, Michael. Welcome to London.
I think the U.S. can ill afford to slap too many shackles of regulation on AI companies because they're in competition with China, and I think Israel won't do it. And so when you look at kind of the key markets for AI development, where the U.S. is first and China is second and Israel is third, I think those are likely to be less regulated than most, and certainly than Europe. And so those will be advantaged economies going forward.
So we had Alex from Scale AI on the show the other day, and he said the thing that we're not talking about enough is that, really AI is the most demonstrable power that any country or nation can hold and leverage in a case of war. And we should have closed systems as a result. Open systems would mean that our biggest enemies, Russia, China, are able to access the same levels of technology that we are. we have to close the systems and we have to leverage AI to build AGI to win wars. Do you agree with that perspective?
I agree with it in part. I think it is true that AI is likely to be a key competitive advantage in wars, even significant. Look, we're living through a war in Israel right now. And so kind of closing the kill chain using AI is a thing, not just in Israel, it's all over the world. And there's a big European company now, it's doing a few $100 million of revenue that uses AI to close the kill chain for European armies. And
Helsing?
Yeah. And so this is a real deal. I said before, if the 20th century was about nuclear countries versus non-nuclear countries, the 21st century is AI countries versus non-AI countries. We shouldn't lose sight of the nuclear ones because there's these terrible people in Iran out there, who are looking to acquire a nuclear weapon. By the way, not just threaten Israel, to threaten Europe. That's the key thing people don't understand. They have missiles long enough to hit Israel. They have new missiles long enough to hit Europe. And thinking of them as an AI country is quite frightening, actually. And they might be. They're very smart people there. And I think what is naive about what Alex said is that you can keep it closed. I just think it's tough. The U.S. put a ban on NVIDIA chips going to China. I don't sense that it slowed China down in a meaningful way. I think there's enough kind of semi-degraded chips that you can kind of string together, or open source designs. You can kind of figure this out. I think the world is far more open than we give it credit for today. And so it's really, really, really tough to shut this down. I think we just have to be ever more competitive technologically to stay ahead of the bad guys.
I can't remember who it was, but someone said recently that China is 2 years behind the US on AI. Would you agree with that?
I think they were 10 years ahead of the US on AI and PsyOps using TikTok. I think they were 10 years ahead of the US in sophistication of how to manipulate the minds of young people using AI algorithms in TikTok. I generally assume of my competitor, of my enemy, that they're much smarter than I am. That's the only way to stay ahead. So even if by some bizarre notion you think that they're 2 years behind, you should think they're 2 years ahead.
I slightly worry, honestly. We mentioned a little bit about kind of geopolitics and global conflict. In the investing world, I feel a little bit uncomfortable when I have these 30 to 35-year-old MBAs, nothing against them, but who are getting super jacked up about the margins of defense companies and how defense is the best place to be right now. And I'm like, you are aware of the weight of your words. I know that we have enemies and people have different rights or whatever. But this is still about closing kill chains, and you're talking in your MBA language about margin optimization. It just feels a bit off. How do you feel about this new wave of excitement towards defense, and also being aware of the weight of what that actually means to fund with billions of dollars more efficient killing?
As a father of 4 children who have served in Gaza and on the northern border, which Hezbollah has been burning nonstop in Israel, war is a real thing. It's a very serious thing. It's serious because people get killed. It's serious because it shows what you're fighting for, which is freedom and the values of the West. And there are enemies out there. I've written publicly that I think this generation of Israeli kids is the defining generation. They've stood up and fought for what matters. I think there aren't enough people willing to stand up and fight. Now, these kids, because they've been in battle, have a level of maturity that your average MBA student does not have. And they understand what it means to hold a weapon. Holding a weapon is a responsibility. Israel has a tiny homicide rate, despite the fact that most of the population is armed, and many of them will walk around with automatic machine guns on their back. You can go to a wedding. I was just at one. There are 8 girls in wedding dresses of sorts, and they have machine guns slung on their back. But you learn to respect it. You learn to understand that this is a serious matter, and that if you're not careful and you're not responsible, then people get killed. And at the same time, I think that there was always an alliance between Silicon Valley and the defense industry, and patriotism, to use, I'm from the United States originally, is a real thing, and it should be in tech. You should be patriotic. I think patriotism is a great thing, a wonderful thing. People should be proud of their people and proud of their country and proud of their cultures. That's not the same thing as my margin, your margin is my opportunity. I think there will be a lot of money made in defense going forward. I think people way underestimate what it takes to sell defense, to government buyers, the regulations, how hard it is to sell. If you've never sold defense technology and you just come out of an MBA, good luck. Palantir took 20 years to crack this code. Andrew cracked it much faster because of Palantir. Other people have done it. This is a profession. It's not a couple of guys, in Palmer Luckey, people kind of, because he's dressed in a Hawaiian shirt, don't take him seriously enough. Trey Stevens is there, who was at Palantir. Trey Stevens, the Founders Fund. That guy is incredible. And he knows more about selling defense technology than everyone's forgotten. And that's just different. And so people will lose a lot of money chasing the new thing, which today happens to be defense in addition to AI.
But we're seeing this move to hard tech. It's people seem to agree with you, actually. SaaS is over-proliferated, too competitive, whatever we want to say on that. But actually, we need to move to hard tech. We need to move to whether that's climate, but much more physical, challenging style of investing. How do you see that, Michael? Because I think a load of software investors are going to lose their shirts investing in a completely different type of company.
Listen, I'm unencumbered by any knowledge of technology or software, and nor management experience, by the way. I've never managed anything, and I can't write a line of code. Last line of code I wrote was in the 7th grade. This is the venture business. You're going to lose a lot of money. You're going to lose a lot of companies. The question is actually, why does a founder want to take your money if he comes from something else other than software? And I think that'll be interesting and very Darwinian. Some founders, or the great founders, are likely not taking SaaS investors' money because the SaaS playbook, as it's become called, doesn't apply to any of these harder technologies. And by the way, we've kind of dichotomized this. Either you do SaaS or you do this ridiculously hard technology like Anduril. There's also in the middle, whether it's semiconductors or these kind of new emerging fields in synthetic biology and synthetic chemistry. I've coined this term. When I grew up in this business, fabless semiconductors became a thing in the late 90s. I was an early guy around a company called Galileo by Avigdor Wilentz, which Mellanox came out of, and a bunch of others. Fabless started to be a thing in the 90s. I think we've now gotten a labless. So you can do synthetic biology. You don't have to build a lab. You can outsource. Part of what happened, I mentioned before that in early 2000s, late 90s, we built out this giant fiber optic infrastructure. ZIRP built out a huge amount of biological infrastructure. And so now you can just rent labs for cheap. And so I think we're moving to a labless model where you do kind of AI, in your office and then send out things for testing to labs and maybe even some manufacturing to capacity that's been built over the last decade.
But transparently, Michael, I just don't feel intellectually equipped to underwrite a AI synthetic biology company. I'm humble enough to be like, I don't understand it.
That's my advantage. I don't understand anything about software either. So,
but you do.
No, I've gone back to learning chemistry now.
You're very humble, but you understand it very well.
No, I've gone back to learning chemistry and studying chemistry now. By the way, I didn't do very well in high school chemistry. I had a teacher who I think thought, nice, he was right. I wasn't very good at chemistry. But I've used actually ChatGPT now to teach me chemistry, and I've been doing kind of high school chemistry again through these things, and the founder. And what I did was I brought this guy back from America. He's an Israeli guy with a PhD from the Weizmann Institute who had built a synthetic biology lab at Harvard Medical School and then went to Amazon to their moonshot factory. And I convinced him to come back to Israel. I put him in the office next door to me for a year. And so I learned by osmosis the very little amount of extra chemistry I now know. And we built this company together. And I think that's how you build companies. I don't really know anything. I'm invested in empathy.com. You had Ron Gore on your show, I think.
No, I haven't had Ron on.
You should have him on your show. I didn't.
She just had Danny Reimer on from Index, and he was saying about Ron the other day.
Yeah, we're so fortunate to have Danny lead the last round. And it's a great band. We got Joel Cutler from Catalyst and Danny and myself and Ron, and it's just a lot of fun. I don't know anything about the life insurance market or how next of kin handle grieving. It's okay. Hopefully it keeps me humble enough to say, I'm really sorry, I can't help you terribly much, but here's who might be able to.
You said before, when we were chatting before the recording, that I could just exploit you for your wisdom and your more experience, let's put it that way. I think you said age.
My age.
Yeah, but I increased wisdom is what I'll go for.
On my podcast with Beezer, I said we should talk about ageism because she should probably get rid of me from the fund. I'm too old to be doing this business.
Listen, I want to start on like my big concern right now. And I sound like I'm the old one, but I'm wondering where's liquidity going to come from? Like I'm looking at the different avenues, which is IPO, it's M&A, and then it's like PE. And I just want to hear your wisdom and experience on this because I'm concerned. M&A seems totally shut. Lena Khan seems like the ultimate challenge.
Socialist.
Yeah, to M&A. How do you see M&A markets? Is it completely shut? Am I right to be worried?
Lena Khan, I'll say it openly, is I think a threat to American capitalism. Whether Biden or Trump gets elected, she needs to go. Because we need to be able to have M&A for the big companies. And as best I can tell, she hasn't redefined what antitrust is. And so I think she's taken a lot of liberties that are just bad for capitalism globally. Where's liquidity going to come from? So I have bad news for you. Most people don't get liquid. Actually, by the way, not most people, like 98% of people don't get liquid. This is a very difficult environment, number one. But number two, this actually is a hard business. I know there's been like an explosion of venture capitalists. It's a hard business.
Let's just go back a step. You said that most people don't get liquid. One way to get liquid ahead of time is secondaries or to sell parts of positions.
If there are buyers.
If there are buyers.
One of the things I've discovered is, so let's just back up. A tiny number of companies get sold or go public. I don't buy that the IPO window is closed. The IPO window is wide open. The question is, what's the price you're willing to take? And so you can go public. Reddit went public. It's done very well in the public markets. It delivered a stellar first quarter after going public. It's doing very well. It's like a $7 or $8 billion company right now. You don't need to have a $500 million or $1 billion of revenue to go public. We took Lemonade public with $60 million of revenue. You should go public early and the markets are open. Take the price the public markets will give you and build your company in the public markets. You will be better off for it. I am a huge believer in that.
Would you really say that to your companies today? You're at 200 million in there and they're going, you know what, actually public markets will probably give us 2x premium in 18 months time.
I don't know if they'll give you a 2x premium in 18 months time, but go. And by the way, if the bankers are playing this game, we want you to have $500 million, et cetera, find a second-tier banker. They're just as good. You don't need to raise $500 million when you go public. Take your company public. Let's say $100 million of revenue. Take your company public at $600 million, raise $80 million, build an efficient business, and go. Just go build it there. It's like this is.
I think people forget that your Shopify went public at 700 million.
Yeah.
Like some of the best businesses in the world.
Amazon, the best business in the world, went public. Everyone's forgotten that Facebook went down 50% after their IPO. It's one of the biggest companies in the world today, now called Meta. Maybe that helps. It's okay. And everyone's like expecting like PE to turn up and buy these companies. I got bad news. Number one, they're going to buy a tiny percentage of companies. Number two, interest rates are way up. They can't borrow anymore. Number three, they're incredibly price sensitive. And so most companies waiting for PE to come save them. I hear there's like this whole meme right now that PE is going to be the buyers of the future.
Well, so listen, we had Mark Suster on the show and he said, listen, PE will be the primary buyers for the next generation of software companies. I just want to touch on a couple of different components that you mentioned there. You said about the cost of capital. How does that impact how they think about buying for people that don't know?
It drives prices down. Increased cost of capital drives multiples down. Just what it does. When interest rates go up, multiples go down. It's the laws of physics. Mm-hmm. And so they'll pay a lower multiple because their cost of capital is higher. And, people are just not going to get liquid the way they think they are. And the top part of the cap deal, this happened, by the way, in 2000, 01, 02, 03, 04. The top part of the cap table got its lick-pref back. People have forgotten the lick-prefs matter. And they got their lick-pref back. And in some cases, there used to be an 8% coupon on these things. Many cases now there isn't. They took an 8% coupon. And then what was left went to the rest of the cap table.
Are you concerned we're going to see many more plural sites? Plural site obviously happened last week, which Vista wrote down from 3.5 billion to 0 because the cost.
I'm not concerned. I'm certain. It's happening. We just don't know. By the way, in venture portfolios, there's a lot of this also. And I also wonder a lot about how many SaaS companies get undermined by AI right now. And there's a lot of SaaS portfolios sitting at hefty prices in people's portfolios, hefty values in people's portfolios that aren't worth that anymore.
You're certain. So that means that there's a ton of companies that PE have bought where the cost of that debt is now way too high and they are in trouble. Does that mean we have a generation of, as I think Jason Lampkin puts it, mulligan PE funds? And do they just get let off the hook for it?
I have no idea. Whether they get let off the hook for it, I don't know if it's a ton of companies, but it's not one. It's not just Pluralsight. There's a lot more like that out there. There's a lot more like that out there. And we also think about the following. If you are a PE fund that just took a significant write down on one or two big software purchases, you can have appetite to buy something? I don't think so. There's a small number of really great businesses that are built in venture. It's like 10 a year. And some other ones get smaller liquidity events, which is great. We should have that. But if you can get paid 10 to 20 times on your medium companies, or even 5 to 7 times on your medium companies, it's not a bad outcome. I don't want to mention the company name. We talked before on the show. We just took 100% of our equity off the table in a company. I think we did 11x or so. We have a different view of the company than management, some of the other investors do. That's fine. It's totally fine. And we're very happy, and we're very happy. We'll be super happy if the founder makes it into a 30x and we were wrong. We'll be so happy for him and so happy for the other investors. But liquidity is a thing. And by the way, the last thing I'll just say about the secondary markets, we've discovered, you get these emails, like you probably get them also, 2 a day, that says, I got a buyer in the market for so-and-so company. So over the last 3 or 4 weeks, we decided to do a little experiment. We reach out to them now. We used to ignore them. But now it's interesting because you discover there are actual buyers there. There aren't. Okay? There are not actual buyers there. It's, hey, okay, we can hold this price if you get us due diligence material on the company. These are just people looking for data. And so I think most of those buyers aren't out there either.
Very rarely do you hear the advice to sell all of your position. The kind of canonical advice is, well, I'll sell 33% at a time in increments. Selling all of a position is respectfully a strange take. I would never sell all of a position, Michael. I would sell 80% maybe, even when I didn't believe, but I would still want to ride the upside on 20% in case I was wrong. How did you think about that 100%?
You asked me before we got on the show, what was the biggest mistake I made during ZERP? Right. One of them was not selling 100% of 1 or 2 positions when the prices were high. I'm actually in the opposite camp generally, which is ride your winners. That's the general camp I'm in. I think the question you need to ask yourself if you're a venture capitalist and you sit on the board is, do I have an information advantage or a unique insight that somebody else does not have? And if I think I have that, I should act on it. And if I should act on it, I should act on it with conviction. It's like when I go into companies, I don't want a half position. If I have conviction, I'm going to take a whole position. This business is an outlier business. It's just the nature of it. So take the whole position. And if you think you've hit a good return, take the money off the table. I don't think you average into positions in the venture capital business. You do it right in the public market, so you kind of average into a position and then average out of a position. I don't think this is like this. This is a binary industry, very, very binary investments, and I'm in that binary camp.
Do you do pro rata?
Rarely.
Why?
I kind of drank the benchmark Kool-Aid. We don't get the same kind of credit the benchmark gets, that because Aleph invested, so someone's going to invest, so we don't have to do one more round. But we try to kind of peel back on it. We think we have to buy our ownership in the first round. Our unique insight is in seed and A. Buy it. Write the check. Buy it. We wrote this giant check to a company called Dream Security, which is AI infrastructure for protecting critical assets in countries. It was the biggest check we wrote. Crazy competitive deal. Incredible team.
When you say the biggest check you wrote, it's like proportion of fund, like 10%?
No, it was initial check 6.5%, 7% of the fund.
Okay. They're
not going to need to raise any more money, it looks like, after the A. And so they can, but they probably don't need to. If I didn't get my ownership in the A by writing this big check, I wouldn't have a position. And I still feel like I'm sub-level. I'd love to have more.
I think one of the biggest misnomers is, hey, we'll place a load of bets and then we'll be able to concentrate capital into our winners. Whenever I hear this, I'm like, are you high? Like, when does that ever... My best performing companies, generally speaking, like 99% of the time, have Sequoia and all the best all over them. I'm not like, oh, sure, I'd love to go treble pro rata.
I was talking to a venture capitalist, Jesse Beiruti at IA Ventures.
I like him.
I like him too. He made a very smart observation. He said that we do pro rata into our middling companies. Super interesting. He said the good ones just kind of get, they become runaways and you kind of can't get more capital. And bad ones you want to put money into. But sometimes one out of some number of these kind of middling companies where most people don't see what's going on there at the beginning, but I do. You give them a little extra capital or you kind of double down once or twice and you end up with a winner out of this kind of middle part of the portfolio. That's a giant winner. I thought that was super insightful.
I look at my fund one, which is a tiny 8 million fund. Actually, our best value drivers today were all in the meh.
That
category.
happens a lot.
And the worst performing companies were all in the rocket ship category. They're the ones that went to zero quickest.
Those are the ones you should have sold 100% of as they were on their way up.
I should have done. I know, absolutely I should have done. But actually, I think there was a big difference between consumer and enterprise there. Like consumer, sell. Because what I found was it's much more transient of whether it works or not. Enterprise, you've got a lot more predictability.
Consumer is ephemeral.
Yeah.
And sometimes works, sometimes doesn't, sometimes goes out of style, sometimes goes into style. I think of consumer as fast fashion in many cases, unless you build a moat. And I think there are rare consumer companies who build a moat. Apropos the AI conversation, somebody from target consumers, it's really hard to tell a difference visibly between OpenAI and Anthropic and any one of a number of models. So you kind of ask yourself, what's the moat? So let's say the moat's the data. And over time, some people will note that it's significantly better. It's like Elon Musk is talking about XAI is going to be the place of truth. I hope he's right. I'm not sure how I'll know. That's kind of a question. And so how do you build the moat on those businesses? It's not clear to me right now. Google built the moat because they were by far the fastest, and then they had this kind of reinforcing ad business that added on to it. But who gets to build a moat in these businesses is not obvious to me.
We spoke about the three different exit sources being M&A, IPO, PE. When you're making investments, do you think about kind of value creation and pathway to exit?
Nope,
nothing at all. So we don't outcome scenario plan of, okay, if Honeybook does X, Y, and Z, then we have this outcome. We don't think.
Nope, for a variety of reasons. Number one, because companies pivot. Number two, because you convince yourself of all sorts of stupid things by kind of dreaming about the exit. And number three, it never works out like that, so why bother?
Do you think we're going to see a generation of funds die, Michael?
Of course. Bruce Dunleavy from Benchmark used to say that venture capital has the highest barrier to exit of any business out there. No one wants to leave. The management fees kind of keep coming. I think that's true. So it takes longer than people think. But yes, of course.
And which segment is that?
We had a whole good generation of people grow up during ZERP. And, now reality is biting. And so, yeah, of course.
But who is
That's not a bad thing, by the way. It's like startups going out of business. You recycle the talent into something better.
Who is that segment, though? Is that kind of old, ailing funds that haven't innovated in the Valley style? Or is it the micro funds where it was respectfully, operators who had $5 million funds on the side and were doing it part-time because it was kind of cool?
I think the first style of funds that goes out of businesses is funds where there's 3, 4, or 5 partners and only one of them is good. And then that person gets tired of holding everybody on their shoulders and they leave and set their own thing up and everyone knows. I think that's one. There's just some people who won't deliver capital back to LPs and they'll be gone, and some will be big and some will be small, and it's fine.
I've been shocked by how much focus LPs still place on TVPI. I speak to a lot of LPs, and I thought given the last few years, they would reduce the importance of TVPI and just focus on TV. No, that's still oh, wow. I'm really? You still give a shit about that?
Well, no, they should actually. In this, I had this tweet and back and forth with Ibrahim Ajami of Mubadala, that the DPI is what matters. And that's true. If you didn't take money off the table during, the ZERP era, there's something wrong. Let's just be clear about that. But TVPI actually matters because I had this conversation with one of our LPs at our annual meeting, which is if the thing is compounding at a high rate and keeps going, that's not a bad thing. And I can kind of think through, if I kind of wait another 2 or 3 years, that this will be worth a significantly larger amount of money. The question is one level beneath TVPI, which is how real is it and how sustainable is it? People in the venture business, and this goes back to the previous conversation about competitive markets versus non-competitive markets, underestimate moats on businesses, the value of moats and competitive advantage on business. There is insufficient time spent on how do I deepen competitive advantage in this business. To take a financial rendering of this, multiple is my expectation for future cash flows. So the question of future cash flows is not just how much cash it is per year, but how many years this goes on for. How many years this goes on for is a function of competitive advantage. So you need to think through how deep my competitive advantage is in a given category. There's a lot of talk about Google right now. Does AI undermine their ad model? Yes, but that competitive advantage is actually really deep, I think, for the time being. How long that lasts, though, is really the question. And so, and that depends on consumer behavior, which is fickle, right? How much of it moves to a different modality other than search. And so the question that I think needs to be asked in TVPI land is these underlying portfolio companies, how deep is their competitive advantage? How sustainable is the growth? And that's key. And I think when you kind of dig that level deeper, you'll find that a small number of companies matter to TVPI, and that matters.
You said how sustainable is the growth there. We're seeing this kind of transition from a lot of companies, from hyperscalers or hypergrowth to actually just quite slow growth and maybe sustainable growth, but just low growth companies that need to just grind it out. What happens in that world?
I think, we talked about like 100% growth like it was easy for a decade, but it's not. 30, 40% growth is great business. Yeah. So let's just say that first of all. Second of all,
very few have it.
And very few have it. 10 to 15 to 20% growth is tricky. That's a tricky middle place if you're a venture capitalist because it's not clear how you get out of it. These would have been great businesses if they didn't take venture capital. If they took venture capital and stacked a large preference on the cap table, it's challenging. What happens to them? Some of them will grind it out for a very long time until some sort of exit market opens up, as long as they're in control of their own destiny and they're profitable. That's not a terrible way to think about this. Others will be traded in large secondary trades of portfolios. And some of them, if they're good enough, will buy back stock. I just had a company actually that bought back stock from early investors. I didn't sell because I thought the price was too low, but I have a company that generates more than enough cash. We bought back stock. So I reduced dilution in this company, which already wasn't much because it's a profitable business for a while. And we'll see what happens to the asset over time. We will make, by the way, a significant multiple on our capital whenever it comes out. It's not growing. It's probably the CAGR is probably 30, 35%. It's had a slower growth year, but it generates a lot of cash. We'll see what happens. By the way, one of my bigger exits in my career, we distributed hundreds of millions of dollars in dividends. It's strange. It doesn't happen, but it's never happened to me again. But
final one, if you were to analyze yourself today as an investor, where do you most need to improve?
That's a great question. 2 areas. It has been said about me multiple times that I am very, very direct and therefore an acquired taste.
That should be the name of the podcast, an acquired taste.
And it takes time for entrepreneurs to understand that I'm asking the hard questions and being very direct because this is important and urgent and they need to get going about this. And there's no sense of beating around the bush. And so probably I should find a better way to deliver messages that is not as...
Do you care? And what I mean by that is...
No, I don't.
Because truth be told, what I find is the best founders appreciate the directness. Take it or not, they appreciate the directness and move on.
One of the things I found about myself as I'm getting older, I'm getting cranky about board meetings. There's a lot of pontificating at board meetings. And I just think most board meetings, I've come to the conclusion that with good preparation, most board meetings can be finished in 45 minutes. There's real governance that needs to go on there. There's core strategic issues that you need to kind of pound on. But most of them can be finished in 45 minutes. Some need 2 hours. None need 3 to 4 hours. And there's just a lot of kind of endless sharing of opinions.
For boards that are done in 45 minutes, what is the prep that is done? Is it a Google Doc with 3 core questions that people think about ahead of time?
It's generally a letter and not a presentation. It's rich in data, but it upfront identifies these are my core 1, 2, or 3 strategic issues that I got to get board input on. And you prep for it, you do calls beforehand, and then the conversation is super concentrated. And because you're attacking the question, I find that people kind of don't expand. All these boards, they show endless amounts of numbers, and people want to dig into the margins, and you show a product plan, and everyone wants to be the product manager on the board. It's like, just no. I'm getting cranky about this, and I probably should moderate my behavior, so there's another area for improvement.
Do you find Zoom board meetings are effective as in-person?
Not at all. I don't like Zoom at all. I hate Zoom. This is better.
Way better.
I didn't invest over Zoom during the pandemic. I met people out of a farm. I met people, and I do everything in person that I can. It's harder now because you have board members who've invested from all over the world. It's just hard to get everyone in one place. But I think in-person board meetings matter a ton. And by the way, I'll spend 2 hours in person. Because I like people. I actually love the people, and I think it's harder for people to pontificate in person. And so by the way, the other area I got to get better at by a long shot, you can get really absorbed into these companies.
Yeah.
And sometimes I need to kind of pull myself out at a high level because I think, you could just be too intense around these companies. And my job is actually to sit at 10,000 feet.
Why is that bad?
Because I think it can rattle entrepreneurs, particularly first-timers. Second-timers don't get rattled. Tom Barr didn't get rattled by anything. Ron Gordon didn't get rattled by anything.
Do you prefer second-time founders?
No, I love the whole first-time thing. And I have this company that's kind of building the monetization layer for LLMs now in a very unique way using blockchain. And this is a company that started during the pandemic. We were about 4 kilometers from each other. And when there was shutdown, I had a pass to get around Israel because I chair the largest volunteer organization in Israel. And I would pick them up and bring them to my house, and we'd sit face to face. And slowly we built this company. Hasn't been launched yet, but they have a couple of hundred customers already. He's an incredible entrepreneur. He was at Google beforehand. And but he was a first timer, and I think it took us time to find our rhythm. And we would spend a couple hours just pounding on this idea month after month after month during the pandemic. And I think he probably would have gotten started earlier if I hadn't been so aggressive.
Final one for a quick fire. Do you prefer founders who've got experience in a market or who are net new naive?
Oh, net new naive.
Yeah?
Net new naive. The fact that Shai and Daniel of Lemonade didn't know anything about insurance, helped a ton. When we first invested in Lemonade, I called a bunch of fintech investors and said, who's the insurance guy? I said, nobody. That's the beauty. So none of them would invest until Sequoia turned up. And these guys have broken every rule of how you build an insurance company for the better because they knew nothing about it. By the way, everyone told us, don't go to New York first. You'll never get a license there. That's the hardest DFS. And we said, go to New York. Actually, I didn't say it. Daniel said, let's go to New York. It was against every insurance expert's advice. I generally have a healthy skepticism for expertise.
Listen, I want to move into a quick fire. So
Yeah.
I say a short statement. What have you changed your mind on most in the last 12 months, Michael?
I was concerned about younger people being too absorbed in TikTok and Instagram and watching what happened in Israel over the last 12 months and how the younger people went out to fight for what mattered, fight for their brothers and sisters, and fight for women who were raped. I think younger people, particularly in Israel, but maybe elsewhere, are going to surprise us, and this is going to be an incredible generation who's going to be forced to stand up and fight because Israel's one place, but there's Ukraine, and there's more of this going on around the world right now. And we saw what happened in Germany last week, and so I think younger people are going to surprise us.
What's the biggest misconception of the Israeli startup ecosystem?
I'll tell you this, by the way. We've raised an incredible amount of foreign money into our company since October 7th, an insane amount of money. It's wide open for business right now, and investors are on the ground every day. That's right now. But the biggest misconception is people think Israelis know how to scale things. And for the most part, when you grow up in a small country, it's harder to think of scale. And so when you're a foreign investor, you need to help Israelis think in big scale.
A weird and hard one. Which competitor do you most respect, and why them?
I said before, I respect all competitors, and I think they're 2x better than I am. I have to work harder than anyone. I said this to Beezer, if I'm not the hardest working venture capitalist out there, shame on me, and I'm going to get killed. These guys are all 2x better than I am. I was on email with Mamoun Hamid from Kleiner this morning. That guy is so good. I think, how do I become Mamoun? I just think they're all better than I am, and more naturally suited for this business. So I got to work harder.
What's the biggest piece of BS you hear most often?
Board members giving product advice.
I completely agree with you. What's the biggest sin of the zero interest rate environment?
Probably not having sold enough of my portfolio. but in general, when things get too easy, if something is not hard, it doesn't matter. If something is not hard, it doesn't matter. And this is supposed to be hard, and life is supposed to be challenging. And when we succeed in challenging things, whether it's relationships or hardships or defending freedom or building a startup company, that's hard to build, like Anduril or which is the synthetic chemistry company, we feel satisfied afterwards. This is meant to be challenging. Life is not supposed to be necessarily easy, and you got to keep working at it and keep working at it. The Protestant work ethic is a real deal. It matters, and you got to keep it. This hard work matters. And so, in ZIRP, the other thing I think, by the way, look, I never invested in nickel in China. I think China was a ZIRP phenomenon also, China investing.
Why?
Yeah, I think people look for yield in other places and ignored the risk, what I call stroke of pen risk. I'm not the only guy who calls it that, where the government just take away your assets. And so, but because people are chasing yield, they just kind of, send it over.
That's like a mic drop at the end. Tell me, my friend, where do you want to be in 10 years? Where is Aleph in 10 years' time? You now do the content platform as well.
Yeah.
And then your partner does the data platform.
Yeah.
What do you want for Aleph in 10 years?
Well, I don't know. I hope they'll keep me around. Like, I'm old for this business at 53. And, I don't ignore the data, which says as you get older in this business, you don't do as well. And so I hope they'll keep me around.
Okay, you've got sourcing, selecting, servicing. The 3 components of venture, just say. Where do you think you're best and worst? So Keith Raboy on the show said he's worst at sourcing, and as time, relevance and that sourcing is his biggest challenge. How do you think about sourcing?
I've stopped sourcing. I get all my deals right now through referrals of 30 years of being in this business. And so I actually don't do proactive sourcing anymore. I don't know if I was good at it or bad at it, but I don't do it anymore. I need to do 2 or 3 deals a year. There's enough that come my way that I think are super interesting that I don't do that anymore. I don't think I provided enough kind of management help to companies because I don't know how to manage my way out of a paper bag. I think where I do better than average is networking. I have a large global network, and I think that is valuable. I think if you have good chutzpah and are not bashful, and you know enough people, you can reach anyone in the world. And I think that's valuable. I had to get the CEO of a Fortune 10 company in the last 48 hours. It took 2 hops.
Final one. What question do you not get asked that you think you should get asked more?
I get asked the first level question of how do you balance your time? And I think there's no such thing as work-life balance. You've heard me say it 100 times.
I get asked that one too.
The second level question is how do other people think about the way you balance your time? That's the better question to ask. And I think if I'm self-reflective, there are many people who I love and respect who probably think I don't give them enough time, and that I don't have enough time for the things I should be having time for, whether it's my day job as a venture capitalist, community work, family, etc. And I think as they say in Hebrew, after 120, which is when you go to the pearly gates, I'll probably have to give judgment for not having given people who wanted that time the time.
Michael, I always love our chats. I'm so glad we could do this in person. So thank you so much for joining me.
Harry, it's so good to see you. Keep doing what you're doing. You're providing just an incredible service, and thank you for taking me as an LP in your fund.